Dani's back. 30 minutes until the start of the cash trade. I'm Matt Miller.
That's why stocks are up, obviously. I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Apple hits reset on AI as the company ousts its machine learning chief.
And Michael Dell's deep pockets, the tech mogul contributes over $6 billion to President Trump's account for newborns as the president calls on corporate America to follow his lead.
And risk appetite is back. Morgan Stanley's Mike Wilson has a bold new bull call. He joins us this hour.
Really excited for that conversation. But first, Matt, some of the things that we're looking at this morning. One of the movers is Warner Brothers Discovery. It's up 2.8% in the pre-market. So the second round of bids are coming in, still the same names, Paramount, Netflix, but it should be worth noted that it's mostly cash offering from Netflix, and the auction could wrap up in the coming days or weeks. The offers, they are binding, which means the board is in a position to sign off on a deal quickly if its goals are met. The reporting suggests that they want something like $30 a share for this deal.
All right, very cool stuff. But even cooler, Michael and Susan Dell just dropped a record-shattering $6.25 billion to give to 25 million children. That's $250 for each child to kickstart their investment futures. The gift expands the new federal Trump accounts, which seed $1,000 for babies born starting this year, 2025 to 2028. That's for newborns only, but this is for any kid under 10, and I think they're going to start out with a certain number of zip codes. And I believe it may be the largest single philanthropic gift of all time to a foundation that's not, your own or your kid's foundation. So giving money actually away. And as a result, it's interesting. I looked at Dell shares when this story broke. They were doing a whole lot of nothing. Now they're up 2.7% in the pre-market. So it's actually moving the shares.
Such an interesting story. We're going to talk more about it and how one would classify themselves as a new board, maybe to get access to that money. Also, we're keeping an eye on Apple. Its AI head is stepping down from the role and will leave the company entirely in the spring. They've struggled to keep up with competitors in AI, including Google, which is posing a risk to OpenAI, with reports that Sam Altman told employees it is code red for ChatGPT to make improvements in its products. For more on Apple and OpenAI, we're joined by Bloomberg Tech co-host Caroline Hyde. Caroline, it was a story earlier this year, like every day, this AI person from Apple is being hired by Meta, by someone else.
Yes.
Who's left?
Yeah, well, not John Giannandrea, who is the lead and perhaps one of the most unsurprising exits that we've had. He came 7 years ago from Alphabet, from Google, and he was really leading the AI charge that then was a total damp squib. Not only did they basically pick up the generative AI mantle 2 years after ChatGPT had exploded onto the situation with Apple Intelligence, then Apple Intelligence wasn't very impressive. Then they had to delay the Siri rollout. Siri's got to get an awful lot better. And then, of course, there's the dialogue that they're not going to be building their own large language models internally. They're going to be looking to other models. Maybe Google's going to be the provider. There was talk of OpenAI, of Anthropic being assessed. That really hit morale. And more broadly, we're seeing, therefore, John Giannandrea take an exit. He's going to stay till the spring, but he's moving on. But meanwhile, he's lost an awful lot of his team, and his team is getting redispersed. It's going to be put under the COO, under the software head, Craig Federighi. We're going to see also the services chief, Eddie Q, get a little piece of the pie, and they have hired new talent. We have seen Amar Subramania come over, AI researcher, was at Microsoft, was at Alphabet. He's had 16 years under his belt at Alphabet, for example, so there's new blood, but boy, do they need to change the narrative. And in many ways, people have been choked off by Apple's own discipline on privacy. Now, because they're so important about edge computing and AI within the actual phone, that means you can't run at the bandwidth, at the parameters that you're seeing rivals do it. So their own LLM foundational models are going to be subpar on that particular case.
Caroline, we've been following, and you and Ed on your program have been following Michael Burry's move,
Yes.
the famed big short investor who is short or buying puts on NVIDIA as well as Palantir. But he didn't short Tesla. This is a story this morning, and I thought, wow, that guy has cojones to short Tesla, right? So many people have been run over in that trade. He does say it's ridiculously overvalued.
I mean, he's also pivoted his entire company. He's shut down Scion Asset Management. His now business model seems to be Substack. And I have to say, if you look at the amount of people that are subscribers and they're paying the full $300 a year to the guy, he's making tens of millions of dollars. But he is putting out there that, surprise, surprise, a company that trades at more than 200 times future earnings is overvalued. Who knew that maybe Tesla was deemed to be trading not always on its fundamentals? But his issue is, again, one that's flagged by a lot of institutional investors when we just had the paycheck go Elon Musk's way, that pay package of $1 trillion. Dilution. He's fed up with dilution. He was issues with that with NVIDIA, with the way that you get stock compensation. He's got issues with the money that's going to Elon Musk. He says it's going to be diluting you to about 3% every single year, dear shareholder. And then he's also got issue with the fundamentals. So he's broadsiding with his pen and with his written word now, rather than perhaps his money.
Yeah, he's not the first investor, of course, to say. I remember Corey Johnson on this network used to rail against Tesla every time they would come out with earnings and say, I can't believe this stock, this company is worth, hundreds of millions of dollars or multiple billions of dollars. And now, obviously it's $1 trillion company. Caroline Hyde, looking forward to your program at 11 a.m. Bloomberg Tech with Ed Ludlow. Let's turn to the top media story of the day now. Warner Brothers Discovery fielding a second round of binding bids as the auction is heating up. Reports say Netflix has pitched not all cash, mostly cash offer, while Paramount's offer includes debt financing from Apollo Global Management. For the latest on this competition, we welcome Bloomberg Intelligence media analyst Geetha Ranganathan. So, Geetha, what do we know about the bids out there and who's most likely to take the prize?
Yeah, that's really the big question, Matt. So obviously all second round bids in. We don't know any dollar value just yet. What we do know from the first round was that Paramount had offered, they'd made 3 offers. The last one was at about $24 a share for the entire company, which was rejected. We know David Zaslav is looking for something close to $30 a share. Majority of that value, Matt, is going to be with the studio and streaming unit, which is the unit that both Comcast and Netflix are chasing. But just the fact that Netflix came out with a majority cash bid, I think just tells us how serious they are, because all along I think there were a little bit of, there was a little bit of hesitation, reluctance about whether Netflix was really going to go seriously after Warner Brothers Discovery. I think just the fact that they come out with this, majority cash offer shows us that they're a very serious bidder and that this process is really, really heating up.
What does that deal actually look like? If it's a company that, at least as of Monday close, has a valuation of something that's like $60 billion, I mean, Netflix probably will have to seriously tap the debt markets to get a deal like that done, won't they, Geetha?
Oh, absolutely. If, we're looking at a value of about $28 per share just for the studio and streaming part of the business, Dani. So you're looking at, anywhere like about $65 to, $70 billion, majority of which will have to be, obviously is in cash. So they will have to tap the debt markets. There's no doubt about that. They have about $9 billion of cash on their balance sheet. Obviously a very, very well-capitalized company throwing out, tens of billions of dollars in EBITDA, so they should have absolutely no problem accessing the debt markets. But you're right in the sense that initially, just with the amount of incremental debt that they would have to take up, maybe upwards of about $50 to $55 billion, there will be some amount of free cash flow dilution just because we're looking at almost about $3 billion of incremental interest expense.
Hey, Geetha, thank you so much for covering this for us. That's Geetha Ranganathan of Bloomberg Intelligence. And I'm pleased to say that now joining us is Morgan Stanley CIO and Chief U.S. Equity Strategist Mike Wilson, who will be sticking with us for a lot of this hour. Mike, wonderful to see you. Thanks for joining us. Just picking up on what we were talking about with Geetha, this idea that you have Netflix making a cash bid and it's going to have to seriously tap the debt markets. It's a trend that's been going on for some time this year, not just Netflix, but the other tech giants. At what point does this dilution of free cash flow play back into equities? Again, not just with AI, but with a company like Netflix. How much are you paying attention to that?
Well, it's something we haven't seen, right? So, I mean, this is the next stage of the cycle, which is we start to see, more aggressive behavior with the balance sheet. So, it will ultimately, there'll be credit issues, but that's not today. I mean, this whole process is just kind of starting, which is why the AI spending can't be over yet if they just raise the money, okay? And now M&A. So M&A is something I've been a little skeptical about until this year. We're starting to finally see M&A pick up. Some of the biotech space, maybe some of the media area. we're going to see more of that, I think, probably in the banking sector. We need to see some consolidation there. But so in other words, it's kind of just getting going. So like we just started the game. So how could it be over so quickly?
More M&A, more IPOs. Do you think we're going to get more animal spirits picking up into 2026? And by the way, I don't want to bury the lead on your call, right? Yeah. What's the new bull call?
Yeah. Well, so first of all, on the M&A and capital markets activity, that's starting to pick up. I'm not that excited or optimistic there's going to be a ton of IPOs. This is not going to be like 2021 in my view. I don't think we're going to see a flood of that, but we're going to see more strategic activity. Raising capital to invest, right? This is the changing dynamic of the economy now. We haven't really seen any investment, real investment dollars outside of AI, and the big beautiful bill is really the catalyst for that, right? Companies now are going to raise capital and invest it in the real economy, okay? So that's, to me, that's a much bigger story than just capital markets activity where people are refinancing their balance sheet or, doing a transaction to get out of an old investment. This is more about investing in the future, and that's a real driver for productivity and real GDP, which is part of our story for next year.
What is your call for next year?
Yeah. So our story for next year is a continuation of what this year has been, essentially, which is that we essentially got a kitchen sink in the first quarter. We made a significant, bear market low in April. That was the end of an economic cycle. I believe that there's now a rolling recovery. Okay, all of the policy changes that we've seen really affect a much stronger 2026 from an economic standpoint. And a lot of that has to do around this investment cycle. So our target's 7,800. That's the base case for 2026. We've written about this as well. I think the very near term, we still have to get over this big hurdle, how the Fed is going to transition to being more dovish. Does that require weaker labor data, or does that require maybe more financial kind of stress in the funding markets? We'll see, what the catalyst is there. That could create some near-term opportunities, but we're a buyer of that dip if we get it.
All right, Mike, you're going to stick with us. As we said, our guest co-hosts really for the hour. Let's get a check on what's going on in futures this morning. We are headed, I guess, closer to that 7,800 target. We closed at 6,800 and change yesterday, so that's 1,000 points away. Right now, futures are indicating another 3% gain today on the NASDAQ, another 0.5%.
It's 1,000 points between friends. All right, look at some of the other movers on our radar this morning. Matt's favorite company, database software firm MongoDB, surging after raising its full-year forecast on the improved growth in the U.S. and EMEA under its new CEO. All of its peers, so Snowflake, Datadog, all of those are moving higher on those earnings.
To be fair, I don't have a problem with the company itself. It's just the name MongoDB. It's like calling your company Total BS.
It is not the same.
It's very similar, right? Okay, strategy is bouncing back alongside Bitcoin after concerns around the stock's premium to the OG cryptocurrency, and of course, a lot of what Phong Le's comments said on a podcast Friday that they may sell Bitcoin hasn't helped that currency or asset. By the way, we're going to hear from Phong Le himself, CEO of strategy, coming up at noon.
Yes, he will, as Bitcoin is up 2% this morning. Meanwhile, Boeing shares, those are climbing. The CFO speaking at a UBS conference saying that they see low single-digit positive free cash flow in 2026 and that the turnaround is underway, Matt.
Coming up, research firm 22V says now is not the time to be shorting U.S. stocks. It could be dangerous. We'll take a look behind their call next. This is Open Interest. Now to high interest. Look what's making headlines around the world. U.S. envoy Steve Witkoff is in Moscow today to present the latest U.S.-Ukraine peace proposals to Vladimir Putin. The meeting comes as Putin claims Russian forces have captured a key Ukrainian city, a claim that Kiev actually denies. The talks follow European concerns. The plan could reward Russian aggression, though President Zelensky says the newest version of the plan, quote, looks better. Companies are literally paying workers to use AI. Firms like Sanofi and IBM are handing out cash as well as points and merchandise to push hesitant employees towards tools like Microsoft Copilot. Some bonuses run into the thousands of dollars, and one CEO is even considering equity rewards for staff who automate themselves out of a job. Research firm 22V says now is not the time to be shorting U.S. stocks. The company says an increase in consumer spending and AI investments will support productivity and deliver profits.
Matt, let's get to the woman behind that story. Joining us now is Bloomberg U.S. stocks reporter Alex Semenova. Again, the lead on that story. Alex, thank you so much for joining us.
Thank you for having me.
Feel bad for the Michael Burrys of the world, perhaps, at least for now. Just how painful has it been to try to short this market?
Yeah, so there's some data from S3 Partners. Basically, 3 weeks into November, shorts were up $95 billion in mark-to-market profits, and they wiped out $80 billion of that haul in the last week of trading in November. It was just the ultimate testament of how difficult it is to bet against this market. We were down as much as 5% from all-time highs back in late October, ultimately to reverse and end November higher. So really, 22V is saying that now is not the time to be betting against stocks. Simply, the economy is just too strong.
It's interesting, you know, my buddy Bob Sloan from S3 Partners, he says people hedging these stocks don't necessarily hate the companies, but it's the only way to hedge this market. I wonder what 22V would say. I mean, do you have to be long?
It's not necessarily that you have to be long. It's just that betting against the strength of equities has not fared well for anyone who is doing that. Marko Kolanovic on Twitter posted something really interesting. He said that now feels like a market where bears aren't excited about selling and bulls aren't excited about buying, especially given the lack of kind of catalyst that we've had with no economic data. We're awaiting the Fed meeting. So there needs to be something to make people excited to go in one direction or the other right now.
All right, Alex, thanks so much for joining us. Alexandra Semenova wrote that story on the Bloomberg side. Let's bring in back Morgan Stanley CIO and Chief U.S. Equity Strategist Mike Wilson. And, you know, when she mentioned Marco, I thought of you. I used to think of the two of you together, right? You were the two biggest bears on Wall Street. Go back to, you know, the inflection point. What changed your view? Because now you're one of the biggest bulls on Wall Street.
Well, it's just flexibility. I mean, it's funny how you get a reputation. You know, you go from biggest bull to biggest bear, and we've had that over the last 10 years, quite frankly. So it's not new for us. I mean, we're happy to go either way depending on what our work shows. Most recently, in the last year, what's really changed for us is the earnings revisions, okay? So like this year, it looks much different. The earnings revision breadth is tremendous. I mean, that's the story, and I think that's the story that most people are still missing. And everybody's focused on valuation. It's like, look, valuations are okay if earnings are going to beat on the upside. And that's our call for 2026, is that we're seeing a broadening out in the earnings story. And we should see a broadening out in the equity story as a result of that. So we're very disciplined around our work. I mean, whether it's sentiment or positioning or, you know, valuation or earnings revisions, I mean, we look at everything, Matt. And I think it's just, you know, at this point in time, it looks pretty supportive from a policy standpoint, from an earnings revision standpoint, and in valuation, you grow into it.
I think, though, this gets back to what you were talking about before the break of why we would get Fed cuts, what the catalyst would be. Because I think a lot of people struggle with this idea that the economy is in a place that it has to have cuts, and at the same time, corporate America is doing really well. Is there not tension in that?
Well, there is, but here's the story. So most of corporate America is not doing well. Okay, just like most Americans have been suffering for the last 3 or 4 years for one important reason. Rates are too high for the average economic participant. This is why the market has been narrow. This is why we have the K economy. Okay, so I think the Fed understands that in order to kind of get the real economy moving again, get high velocity transactions moving in the real economy, rates need to be lowered. Now, they need to be a little bit careful with that because it could create a bubbly type situation for stocks. But I mean, what we don't want to do is we don't want to see the government or policy crowd out a recovery that is very nascent for many parts of the economy right now.
Where is the market most wrong, or where would you have your highest concerns in terms of what happens next year? I mean, is that running it too hot your biggest worry, inflation?
Yeah, so on the positive side, I think people are too bearish on the consumer. I hear it all the time, the consumer, you know, they're in real trouble. Some consumers are in real trouble, which is why they need relief with rates, okay? And there's going to be relief on fiscal next year on taxes, about $150 billion of benefit from the big beautiful bill for that sort of middle income consumer. So I think people are too bearish on the consumer. I think that's where we're going to be surprised, particularly in the first half of next year. On the other side, I would say, yeah, inflation. I think the strategy of running it hot will come back to bite us probably sooner than people think. So if people buy into our call that a new economic cycle began in April, most people would say, well, that should last 4, 5, 6 years. I don't think so.
Well, just to that point, quickly, Mike, before we head to the break, I mean, 2026 is going to be a midterm year. We've already seen this administration pivot to focus on affordability. What sort of risk does that inject into this?
It's a big risk for later next year. I don't think that's a risk in the first half of next year. So once again, we're going to stay flexible, and we may be here a year from now, you may be saying, why are you so bearish? I don't know. I mean, like, my point is, this is a time not to get married to anything for more than, I would say, 6-month view. So 6-month view is kind of the sweet spot right now.
And that in itself is telling. Mike, staying with us, that is Mike Wilson of Morgan Stanley. Coming up also in the next hour, Meredith Whitney is going to join us to also talk about the consumer, what she says are warning signs that are hiding in plain sight. This is Bloomberg Open Interest. Despite seeing record after record from U.S. stocks and gold, the U.S. is lagging the rest of the world in 2025. Bloomberg Intelligence analysis found that among the 14 largest markets, the U.S. currently ranks 5th from last in local currency terms, 4th from last in dollar terms this year. Still with us is Morgan Stanley CIO, Chief U.S. Equity Strategist, Mike Wilson. Mike, so 7,800 is the call for U.S. stocks for next year. How much of that, though, is U.S. beating out the world versus the rest of the world doing even better? Yeah,
well, I think it's both. I mean, the rest of the world can do better. I mean, we've had this call for 3 years. We've been in this sort of rolling recession, non-participatory kind of recovery. And that's the same story for the rest of the world, right? The rest of the world hasn't really been recovering since COVID either. So we're seeing, the Chinese market's doing much better. India had a tough year this year relative. It's fine. I think that's a market that can come back. And then Latin America, as we kind of coordinate maybe this Western Hemisphere connection, Latin America looks quite a bit better. So I think foreign stocks will have a better year. It doesn't mean they beat the U.S., but it can keep up. The real story for next year, though, I want to make this clear. It's not about the S&P target, okay? It's more about this broadening out. And that broadening out is contingent, though, on the Fed cutting more significantly and or providing more liquidity to both financial markets and the real economy needs as there's more capital spending. So there is this hurdle to get over. Okay, but to me, that's the fat pitch. It's not just S&P, it's not just the AI trade, it's all these areas that have lagged.
Right, which is, I mean, when I look at the outperformance of the rest of the world, the strange thing is they don't have the AI play that we have, right? They don't have the Mag 7, and they continue to do better. We'll talk more about this. We got to go to a break right now. Mike Wilson is going to stay with us, though. Right now, we're looking at futures rising into the cash trade, the opening bell on the other side of this break. We are moments away from the start of trading on this, what is apparently Giving Tuesday. I tell you that because you're going to see some charities ringing bells. Right now, S&P futures are up about 0.25%, so clawing back some of what we lost yesterday. NASDAQ futures gaining about 0.4%. December didn't start out so well, but maybe the second day will be better. You do see the U.S. SEC head Paul Atkins ringing the bell at the New York Stock Exchange. So that's not necessarily a charity. Hopefully, if you're very nice to them and this administration, you can get some give outs. But the pledge 1% is what I was referring to down at the NASDAQ. It is Giving Tuesday, apparently, after Cyber Monday. And this is, help me out, Mark Andreessen. Did Mark Andreessen started this or Scott Farquhar? Sorry, Benioff.
Exactly.
I'm mixing up my marks.
Oh, good. By the way, probably worth noting at the SEC, those hats they're wearing are not MAGA hats. They're Make IPOs Great Again. They've taken them off and now they're looking at their own logo. I'm not actually sure.
That's an interesting. What are they doing? Is this like an alien takeover? No. Okay.
But yeah, worth noting that's their hat. They want IPOs to be great again. IPOs are back. We're just saying to Mike Wilson that IPOs are back, but nothing like 2021. Dell Technologies actually surprisingly not moving at the moment. Pre-market, the stock was up a significant amount. There is a new record, or at least near a new record, if not the record, for gifts given to not one's own philanthropy. Michael and Susan Dell giving 25 million American children $250 each to jumpstart investment accounts for their future. The total of that gift, $6.25 billion, builds on the Invest American initiative, better known as Trump accounts. It was created earlier this year as part of President Trump's One Big Beautiful
Bill
Act.
By the way, I see that stock up 2.5%.
Okay, so something's weird with this.
Something's wrong with our board.
Okay, so these shares should be up to, okay, there you go. Weird, it heard you. Shares up just about 2%, Matt.
All right, Boeing expects to generate cash on an annual basis in 2026, marking a significant turnaround from the $2 billion cash burn this year. The plane maker expects positive free cash flow to reach a low single digits level next year. And on that news, the shares pop more than 5%. Let's bring back Morgan Stanley CIO and Chief U.S. Equity Strategist Mike Wilson, who has a 7,800 target for the S&P next year, but you say that's not the real story. It's really the broadening out. And we had seen the equal-weighted S&P rallying 5 days in a row. Do you see that broadening out, bringing earnings to double-digit gains next year? Or, I mean, if you take out the Mag 7, does it look like that?
Yeah, the way it works is, I mean, the way I think that we'll get that performance is the relative spread between sort of and it's really the Nifty 50. It's not just the Mag 7. There's like the high-quality, large-cap companies have been growing quite fast, and the smaller businesses have not been growing at all. That spread is going to narrow. And when that rate of change spread narrows, you'll get relative outperformance of those laggard groups. So once again, those areas would be like consumer goods or transportation stocks, some of the housing related areas, some of the regional banks perhaps, which will benefit from a steeper curve, materials, energy, all these areas that really have not performed for the last several years.
By the way, we took this chart yesterday from John Authors, and it was interesting because, well, yesterday was the 3-year anniversary of ChatGPT, but that's when you started to see the valuations really start to split apart. And you can see valuations for the cap-weighted S&P in blue just taken off, and the equal-weighted just hovering around 20.
That's exactly right, but that makes sense. I mean, because the earnings growth in that blue line was incredible, and so the market's not dumb. The market knows this stuff and it figures it out, and I think the market's not going to be dumb about next year. Now, we could be wrong about our call. Okay, so if we're wrong that earnings growth doesn't recover in these other areas, well, then our call is going to be wrong. But if we're right about our earnings analysis, then that spread should narrow, and that's really the story for 2026.
One of the sectors, though, that we're just talking in the break that you're less enthused about, or maybe even outright bearish, is consumer services.
Yeah.
Why does that get left behind?
So the consumer services has been the winner in the last 3 years. As people stop spending money on goods from the pull forward during the COVID lockdown, they spent money on experiences and restaurants and travel and everything else. So that's going to come down a bit. The other big variable is immigration. Okay, so that hurts on two levels, right? Labor costs will go up for a lot of these service businesses. Okay, and then secondarily, we think real wage increases may improve now at the lower middle income as there's less labor competition because of the restrictions on immigration. Those folks tend to spend more on goods than experiences. So we think that's an interesting trade for 2026.
That's precisely what the Trump administration wants, obviously, and that they tout this sort of comeback in working class wages. The big beautiful bill legislation also should add, we hear from so many guests, a certain amount of stimulus for these corporations into 2026. Do you think that's a big part of it? Absolutely.
I mean, as far as GDP goes, it's probably close to 1% in terms of stimulus, direct stimulus from the big beautiful bill. But if you think about the incentives now to do CapEx, one of the reasons why we're seeing the hyperscalers raise a bunch of capital now, all of a sudden, is because they got to spend the money the next 2 years to get the benefit. I mean, once again, the incentives are, it's like, the Charlie Munger line of, show me the incentives and I'll show you the outcomes. Well, they're getting the outcomes that they want. We want reduced consumption. We want to reduce consumption through tariffs and also maybe some inflation. And we also want to increase investment. So that rebalancing of the economy is very, very important. And there'll be new winners and probably new laggers as a result.
But is there not some phenomenon of crowding out? Because so much of this investment is happening around AI. Crowding out, be it in manufacturing, in energy consumption. In terms of the narrative of broadening out, does that not hamper it a little bit when so much of this economy's resources are being put towards that?
That's true, but remember, think about this. We've had the government doing a lot of the investment for the last 10 years, and private enterprise has not been. So we're trying to reverse that. We're trying to basically use company balance sheets now to invest in the economy. And I think we can all agree we'd rather have companies investing that capital than the government. Nothing against the government, but companies are, they have to get a return on capital. The government doesn't. So I think that's the right strategy. I don't know if it's going to work, okay, but I like that plan a lot better than what we've been doing.
What's the one trade you would put on, for an investor with new cash? Because we always talk to people who say, I love NVIDIA, right? But they already own NVIDIA. what do you put the incremental dollar towards?
Yeah, I think it's the S&P 493, or the equal weighted S&P looking out 6 months. I think it's areas like consumer goods. I think it's areas like the material space that have a lot of a benefit from a lot of this capital spending that's going to be happening. So once again, looking for the areas that have lagged, there are plenty of them. And to your chart earlier, the multiples are cheaper, okay, and the growth is accelerating. So that's a pretty good combination.
In a world, though, where equities continue to hit new highs and participation gets bigger, every now and then you see correlations pop up that maybe you haven't fully paid attention to. I think in the last couple of days, Bitcoin has felt like one of those that has led, or if not leading, has accelerated the sell-off. How much are you now paying attention to the crypto markets to get sort of a gauge of where equities go?
Well, I pay attention to everything, Dani, because you don't want to get caught by surprise. But look, the market has been correcting for 2 months, right? We wrote a note, 2-3 months ago talking about a 10 to 15% correction. People are like, oh, but it's been happening. Okay, we haven't seen 10, 15% in the S&P, but we've seen that more than that in many of these high momentum areas of the market. And I would say Bitcoin is emblematic of the reasoning for why things have corrected. It's liquidity. Liquidity has become tighter. Okay, the Fed is aware of that. That's why they ended QT. Okay, so that liquidity drain, or the lack of abundant liquidity, is causing a correction. And I think Bitcoin is a key thing to watch for that measure. In other words, if Bitcoin starts to rally again, that's probably a good sign that liquidity is actually improving again, and then we can get the next leg of our rally.
By the way, we were talking this morning in our editorial meeting about Costco joining a lawsuit against the Trump administration to try and get refunds from the tariffs it's had to pay if the Supreme Court overturns that. Is there anything, in the Supreme Court realm or in the legal realm that you think could trip up this administration in achieving its goals, and therefore also your investment case?
Well, I mean, clearly there's always things that could trip us up that we're not expecting. I'm not expecting the refunds to be sent out, but I'm also not a lawyer, and I'm not close to the situation as probably others are. What I will tell you is, though, this administration is pretty tenacious, and they're not afraid to go back to the appeals court. So I think even if these tariffs get overturned by the Supreme Court, it's probably going to be years before any refund checks go out. It'll be stuck in the courts, okay? And the damage, at this point, the market's already moved past tariffs.
But will it move past it, Mike, if the story turns into a narrative that's bond markets get hurt from that because deficits can't get eaten into, and therefore equities don't do as well?
Well, we'll see. We'll see how the bond market reacts. If the bond market doesn't react to that, then that's the bond market saying what I just said, which is there'll never be any refunds. We'll move forward. It'll be tied up in the courts, and that's probably the most likely outcome in my view.
Hey, Mike, we're going to leave it there. Thank you for being so generous with your time this morning. That is Mike Wilson of Morgan Stanley. A quick check on the stock market this morning. We've been looking at, again, Bitcoin. That's doing better. This equity market is doing better after ending 5 consecutive days of gains. We are up 0.4%. How's the breath looking? Not great. 300 stocks are down. Just under 200 are up. NVIDIA leads us higher, up 15 points. That's how much is adding to the S&P 500 with some of those other big names like Broadcom and Alphabet. To the downside, P&G having a bad day, one of those consumer staples. A lot of consumer companies not doing well. Visa, Home Depot, Exxon, Chevron, so some oil companies also there in the top losers. A quick check on some of the sectors this morning, too. Energy, I'm guessing, is going to be one of the down ones, and consumer staples. I was just showing you some of the individual names. Tech, though, having a much better day. That is up by 1.3% as NVIDIA outperforms this morning, Matt.
All right, Dani, coming up, we head to Las Vegas for Amazon's flagship annual Cloud Conference. This is Open Interest.
Let's get you some top calls this morning, the analyst action that we are focusing on. First up, Truist Securities saying Six Flags is showing a real sign of a turnaround. They point to the new CEO, a willingness to close underperforming parks, and a more urgent approach to fix long-standing operational problems. The analysts there note that bankruptcy risk appears to be off the table, at least for the foreseeable future. Those shares up just over 5.5%. Next up, KeyBank Capital Markets. They upgrade T-Mobile. They say that risk-reward looks balanced even as structural and competitive challenges persist. The firm also arguing that sentiment is overly negative and worries about Verizon's comeback are overstated. Shares little change this morning. Finally, Barclays starting coverage of Cloudflare with a buy rating. They say that the company's strong position in cloud, cybersecurity, AI, all of that should keep driving steady market share gains. They also say that Cloudflare's higher valuation makes sense because its roughly 30% growth rate is increasingly rare shares up 3%. Matt?
All right, sticking with tech, Amazon's flagship annual cloud conference is underway in Las Vegas. The firm is showing off its all-in-one suite of AI products. Let's head to Sin City, where Bloomberg Tech co-host Ed Ludlow is staying away from the slot machines. Ed, I guess this is what you have to say, right? Do they really have a full suite of AI products that everyone can take advantage of to their benefit?
Yeah, truth is we don't know, right? The accepted status quo is that AWS is the #1 in cloud computing. But the very real question that the street has is AWS the #1 in AI, right? They have very many tools where they say, oh, we have the greatest scale, the best infrastructure. They can leverage NVIDIA GPUs. They have their own in-house silicon, all the things that we'll want to hear about. But it's very sort of piecemeal. When Amazon posted 20.2% growth for AWS in the quarter just gone, the first time they've topped 20% growth on the cloud unit since 2022, they showed tangible evidence that there was demand, real demand, for their own specific AI products. And so that's what everyone's trying to track. Most of the news has not come out here yet, but it's whether we can see evidence that Amazon goes from a cloud provider that hosts other people's foundation models that are genuinely useful in things like agentic AI to showing that it has its own competencies in those fields while warding off silicon threats from Google and its TPU, and also trying to juggle the investments it's made in Anthropic, the partnership it now has with OpenAI, which again is around NVIDIA GPUs, so it's complicated.
It's complicated, Ed, and I just think about the story not too long ago from the Bloomberg News team about just the huge amount of facilities and data centers that Amazon has, some 900 facilities in more than 50 countries. How much of this is a story of also just powering those with AWS and other parts of growth like data centers for the company?
Yeah, I think from a credit perspective, it's very interesting because Amazon is flush with cash. And so one way to look at it is that Amazon's made this pledge to double its capacity by the end of 2027 to almost 8 gigawatts and most of it's AI-specific capacity, right? But at this point, particularly after tapping the debt markets, they have more than $100 billion. And most of the street would look at that and say, we're actually pretty sanguine about the idea Amazon will just outspend everyone to achieve that scale. Again, it comes back to Matt's original question is, do they have anything useful to show for it? They can build and build and build. But again, the story over the past year has been AWS is a place that hosts other people's models. They released their own foundation models a year ago, and the expectation is today, beyond telling us what they're doing with their custom chips and their custom server designs, what about those custom models? Have software companies, all of these great enterprises that rely on AWS, actually been able to do anything useful with that? And are they deriving any real AWS revenue from it?
I got to ask your take on the Apple story. They now have lost like all of their AI employees as OpenAI declares code red. What do you think about the AI space? What are we going to hear about it on your program today?
Yeah, I mean, like on the Apple side, significant story, but the writing was on the wall, right? John Giandrea is going to step down, actually technically retire, and he'll be in place through the spring in this kind of transition period. John Giandrea led the AI effort at Apple at a time where they've kind of fallen behind, right? We've talked endlessly about how Siri is not the product that Apple wanted it to be, and they're actually going to change the leadership structure. So instead of having one AI chief, basically all of the talent leads in that division will report to 3 different members of the C-suite that go to Tim Cook. Apple, I guess, trying to tie the two stories together. There were reports that Sam Altman told OpenAI employees in the last 24 hours it is code red. Everyone needs to focus on ChatGPT, not advertising or the other projects that OpenAI was eyeing. And it probably speaks to this idea you need one core useful platform. Again, that's highly relevant to AWS here in Vegas because they don't have that. They don't have the consumer-facing tool, nor do they have their own version of an enterprise tool a la ChatGPT. They have Anthropic. They also have a relationship with OpenAI. So those are all fair questions to ask AWS executives today. Like they must recognize what's happening in the field.
Hey, Ed, just elsewhere, it's probably worth mentioning, because this story is very highly read this morning, this question of Michael Burry and Tesla. He put on X about 10 minutes ago that he wasn't short Tesla, but still has a narrative that it is too highly valued. One, I think we're going to have to get used to this, because now Michael Burry has a Substack. But what is kind of the concern, especially as Tesla continually works through this huge pay package for Elon Musk?
He said on X he does not have a short position in Tesla, right? And there had been lots of speculation on X that he had. You know, the thing about the compensation package for Elon as it relates to the company's valuation is that those goals set for him over 12 tranches in a 10-year period are mandatory. You know, he has to achieve them in order to unlock voting power. And the argument for those that voted, the few that voted against the compensation package, was that it was dilutory for shareholders and that they wouldn't get a return. But at the end of the day, he's got to take the market cap from whatever it is right now, 1 trillion to 8.5 trillion, and sell quite a lot of software. And that, I suppose, will impact the multiple in the long run. But yeah, we haven't had anything official filing-wise from Burry, right? I think he kind of lives in the ether right now.
That is for sure. Ed, thank you so much. Looking forward to your coverage of the AWS conference there. That's Bloomberg Tech co-host Ed Ludlow. And this afternoon, he's going to be joined by the AWS CEO, Matt Garman, first on Bloomberg. Coming up, Bitcoin halts its slide. Global stocks bounce back. But traders are betting on Michael Saylor's strategy are getting burned. That's coming up next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check of what's going on with stocks. We have the S&P 500 gaining 1/3%. The NASDAQ up 0.75%. The small caps gaining as well as the VIX comes down to a 16 handle. Take a look at what's going on in terms of these stocks. NVIDIA right now up 2.5%, and that trade powering, obviously, the indexes. Tesla, which Michael Burry is not short, down 0.5%, a little bit less than that. Boeing, which says it's going to be cash flow positive this year, getting a 7.5% boost from that announcement. And then Dell Technologies up 3.25% after Michael and Susan Dell are pledging to give more than $6 billion to help fund children's investment accounts, these Trump accounts. Although in this case, you can be up to 10 years old to get hold of that money. It's not clear why Dell shares are moving. Just maybe investors feel like being charitable as well because it's Giving Tuesday. They want to help bid up the stock for the sake of the Dells after giving such a gift. Or maybe they think there's going to be some kind of PIK here. Bitcoin right now up about 2.9%. So Bitcoin gaining after the drops we've seen over the last couple of days. And as a result, you also see Strategy. Used to be called MicroStrategy, but to confuse us even more, they just named it Strategy. Pretty soon it'll just be called S, right? Bitcoin, by the way, holding steady after this week's long slide. Investors in Michael Saylor's S are getting burned with leveraged ETFs tracking Strategy down as much as 80%. Bloomberg's Anna Herrera joins us now out of London. So Anna, tell us the story really from the beginning, from the podcast, let's say on Friday, of what's been happening with Strategy and why it's done so poorly.
You know, Strategy for a long time has just been a reflection of Bitcoin in a way. It's been a way for retail investors to invest in Bitcoin without investing in Bitcoin because Strategy just accumulates and hoards Bitcoin. And that does quite well for the company when the price of Bitcoin goes up. But when we see huge slides, like over the past month or so and a half, Bitcoin has dropped more than 30%. That gets reflected in the Strategy share price. And so there's been a concern that at this point, Strategy finds itself in a position where it might be selling, so have to sell some of the Bitcoin. They've tried to assuage concerns by saying that actually, no, they're setting aside some money, but still people aren't super convinced. Today, you know, the market is steadying a bit, and but there's still some signs that people are concerned and investors are still very cautious.
Hey, Anna, just quickly here, less than a minute, but for this overall Bitcoin market, the volatility that we're seeing, how much of it is behind some of these digital asset treasury companies versus just general risk off?
It seems it's more general risk off as of now. When you speak to investors, they mainly point to sort of the general macro things that you would look at in other asset classes, like equities. People are saying, we're waiting and seeing what the Fed decides next week. Yesterday, the price of Bitcoin went down largely, possibly off of what happened with the Bank of Japan. So it's less tied to crypto as an industry, which is what was happening in previous cycles, and more what's happening in general.
All right, Anna, thanks so much for joining us. Anna Herrera covering crypto for us out of London. Tune into Bloomberg Crypto at noon today, by the way, because the CEO of Strategy, Phong Le, will join Katie Greifeld. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Bouncing back from a dreary start to December as crypto and JGB markets calm down.
Coming up, avocado toast may be telling a bigger story. Meredith Whitney joins us in studio with the consumer warning signs that are hiding, she says, in plain sight.
Meanwhile, Michael Dell's deep pockets. The tech mogul contributes over $6 billion to President Trump's accounts for newborns as the president calls on corporate America to follow his lead.
And will tariffs shake up the Christmas tree business? National Tree Company CEO Chris Butler joins our C-Suite segment on why he's sounding the alarm this holiday season. But we begin with stocks staging somewhat tepid comeback after a shaky start to the month. We spoke with Mike Wilson of Morgan Stanley on his outlook for equities.
Our story for next year is a continuation of what this year has been, essentially, which is that we essentially got a kitchen sink in the first quarter. We made a significant, bear market low in April. That was the end of an economic cycle. I believe that there's now a rolling recovery. Okay, all the policy changes that we've seen really affect a much stronger 2026 from an economic standpoint. And a lot of that has to do around this investment cycle. So our target's 7,800. That's the base case for 2026.
Joining us now is Nancy Tengler, Laffer Tengler, CEO and CIO. And, add to that bull case, Nancy, we have Paul Atkins speaking right now on the New York Stock Exchange. I'm looking at headlines crossing the Bloomberg terminal. He wants to ease rules, regulations, so that smaller firms can do IPOs. And of course, this is one of the big tenets of the bull case, right? We heard Ken Griffin earlier this year saying that's a huge part of it. What do you think about Mike Wilson's bull case and the idea that stimulus and deregulation is really going to power this market higher?
I mean, I like him much better as a bull.
Yeah.
We agree. I mean, we've been talking about the impact of the One Big Beautiful Bill and how it's going to be a tailwind, not just to consumers, but to corporations. I think that's still in place. I think a lot of these concerns over debt are a bit overdone, and I'm speaking of the Mag 7 and the AI names investing in each other. And so I think what you're going to continue to see is what we saw in the earnings season. You saw great earnings growth, strong top-line growth, and good guidance. And the guidance is what matters when you're looking forward. So we're pretty bullish. We think we're in the early years, maybe. I don't know, I hate the baseball analogy, but third inning of a really strong secular bull market that is analogous to the 90s in a lot of ways, but not entirely, at least not yet. I don't believe we're in a bubble.
So does that mean every time you get NVIDIA selling off more than 12% last month, one of the worst months since March, that in itself is a buying opportunity when you do start to see some of ththose debt concerns come in?
Yeah, because if you just think about it, Dani, in March, let's say, February and March, we bought NVIDIA at $100 a share. We bought Palantir at $88 a share. We picked off Tesla at $240. I mean, that was hard to do, but if you think about it, even with the correction that we've had, the modest correction, those are pretty good entry points. So we were buying last week, and we will continue to do that. We weren't in a hurry, so we didn't jump in when the market first started selling off, and we waited until last week, and then we picked off some of the names we wanted down.
Your flagship dividend growth strategy and ETF have outperformed for a decade. What is the common thread or the shared DNA of your holdings there?
So our investing theme, at least for the last 4 years, almost 5, has been old economy companies that are pivoting to the new technologies. Think Walmart. I love that they're doing this symbolic move to the NASDAQ. And then the suppliers of the picks and shovels. So we're looking for companies that are growing the dividend, but are not necessarily paying high absolute yields. So about 18 months ago, we put Google in the portfolio. Low yield. We expect the dividend to grow. And it was a company that we wanted to own and nobody else did. And by the way, I think it was in the Russell 1000 value. I think it's one of the largest holdings. So we've just always been disciplined in that regard. We look for valuation first, and then we don't want to own terminally cheap stocks, so we have our own proprietary research, sit on all the earnings calls. Sometimes it's a little tedious, but that's what we do, and we have a team of analysts.
I'm saying you don't just have AI doing that now, Nancy, to look through all the earnings calls?
It helps.
Some time? Okay.
It helps, but you actually have to listen, in my view, I'm old school, you have to listen to the management. Change in tone, not change in tone. What's Wall Street saying? Are they angry? Are they, So you get some insight into just listening and listening to the same calls quarter after quarter.
Yeah, but my favorite thing is I've talked to executives before who are like, before we do an earnings call, we feed it into AI first to see what AI would come up with, and then we change it based on that. So it's like this weird circular thing of like AI doing the earnings call text, analyzing the earnings call text. And
can I have their names?
Yeah, maybe in the break.
It's good to be prepped. You have your 6 for 26. Last year you had your 5 for 25. Yeah. What's a new addition? There must be a couple, at least.
They're all
one.
new, actually.
Okay.
There's no rules. It's my rules. There were a few I wanted to keep, like Amazon, that underperformed last year. But even like with 5, we had 2 that dramatically outperformed, and then 3 that kind of were, and the strategies, or the portfolio, if you will, is up 27.7%. So this year it's Walmart, AMD, I'll probably forget one, CrowdStrike, Tesla, Quanta Services, and some other very cool company.
You have Power?
That's it? Yeah.
Power. I said that.
CrowdStrike, DHI.
Oh, DR Horton. And that's
Yes.
the risk-taking one where we're expecting housing to turn, and we think DR Horton will be one of the big beneficiaries. Please ask Meredith about it when she comes on.
We certainly will. I want to go back to Walmart, though. This thesis of old economy companies moving into the new economy. How do you, though, sort who's doing a good job of it and who is just doing like AI theater, announcing some splashy AI thing that maybe doesn't contribute too much to the bottom line?
That's an awesome question. So one of the third, fourth derivative companies that we own in our thematic portfolio is Symbotic, and they provide automation and all of the sort of robotics in the back office. Their first client was Target. Target didn't utilize the software. Walmart did, and look at the difference, the exponential difference in the performance. I mean, like 30% of Walmart deliveries are done in under 3 hours. 50% of order fulfillment is automated. That's thanks to their vision and Symbotic. So we look, we listen, and then we do the research. And there are companies that are saying AI every other word, but then there are the companies that are showing margin improvement, customer service improvement, not just cost cutting. And so those are the names we focus on.
Symbotic, I mean, today could be a buying opportunity. I think it's down like 8-9% today.
Very volatile. It was up 20% last week on earnings.
It's up 700% over the last 5 years.
Right.
So it's done pretty well. You mentioned Meredith, and one of her theses that we're going to talk about today is that the kids, the millennials, are avoiding like a Cava or a Sweet Greens or what do you call the Chipotle, these slop bowl stores, because they now all of a sudden have to pay back their student loans again. And she's concerned about the consumer. Do you not share those concerns?
No. I mean, I don't want to be dismissive. She's right, but there are a lot of consumers. And if you look at the distribution, overall, credit card delinquencies are not up much, or they're actually flat. So what you're seeing is the subprime auto loans, and some of that is the young people. But I don't know what the job market was like when you got out of school, but I was given a typing test out of college, and then I went back to that company and became the CIO. So 20 years later.
How did you do on the typing test?
I flunked. But there were no jobs. And so some of us lived at home. Some of us got, we drove used cars. I mean, they'll figure it out, and the adjustments will be made in the economy. The weakness in the labor market is not just the young people. It's also my generation, the baby boomers, or the 55 and up. They're getting retired early, and there'll be an adjustment.
I lived in my fraternity house for like a year after graduation.
Oh, was that because
it was bad
couldn't afford a place, or you just wanted to be in the...
I was looking for a job.
Sure, Matt. I'm sure that's exactly why you stayed in
Dani,
it.
there were none. It was a recession, and it was awful.
Okay.
He's younger than me.
But as part of the millennial generation, when we also graduated, you were dealing with the aftermath of the financial crisis, and you also had this problem of finding jobs. So how much of the adjustment, because there has been a lot made of this current generation. There was this FT graphic showing that 20 to 24, the percent participating and not participating in the economy. So not having kids, not doing that kind of unpaid labor, or just having jobs has been growing and growing. And a lot has been concerned about this, that it is a younger generation that's being left behind and it'll have consequences down the road. So when you see something like that, is that just, look, it's history repeating itself? I'm not too concerned.
I'm not. I think we work it out. Remember, the millennials were never going to buy houses. They were never going to buy cars. And that suddenly changed. And so, you know, you got home formation or household formation. You got purchases of minivans. I never had one, for the record. But, you know, so I think you have to look beyond that. It's a short-term problem. Meredith's absolutely right. But is it a long-term problem? I think that we're in an economy that's in transition. And I'll give you an example. The ISM numbers were not very good yesterday. But if you dug underneath, what you saw was production went expansionary. It was employment that was dragging down the overall numbers. 67% of companies said, we're not thinking about hiring right now. That will change. And we will move through transition. It's always messy, but this is a great time to be alive, I think, and to be an investor.
I mean, I feel like they have to compete for workers since nobody's coming into this country, right? And the demographics aren't on their side.
Right.
You've got to hire. I want to ask about Meredith Whitney's not the only famous investor we're talking about today. Michael Burry also out with not a short, but a call on Tesla, saying it's ridiculously overvalued. What is your take on Tesla at these levels?
So the stock has always been overvalued, if you will, if you're using traditional metrics. I mean, even on
it's
a
worth
price
more than every other car maker in the world combined.
And so you have to ask yourself, is it a car maker? And the answer to that, I think, is no. We put it in our thematic portfolio because of robotics. We think they're going to lead and take the majority of the share. Space, we don't participate with Tesla, but we hope to someday. XAI, now there's going to be a stake for Tesla shareholders. And then you just have the other ancillary businesses, like the Megapack business that's growing. That's the electric utility grade batteries that's growing, the fastest growing business at Tesla and the most profitable. So we're looking at the innovation. It's much like Amazon was. How did you value that company when there were no earnings for 20 years? I missed it because I was a traditional value manager. Got to have earnings, got to have earnings. And then one day you wake up and say, I think this is a transformative company. This one is. I think Michael Burry, with all due respect, is talking his book. And he's been doing that, and I'd like to know why he shut down his fund, because I think that's important for those of us who are listening. But it's the same with Oracle. Oracle had a debt-to-equity ratio of 781% last year, and it was growing half as fast as it is this year, 500% debt-to-equity. It's always been a company that uses debt. So the question really is OpenAI going to sustain and be there? And that will be the risk factor.
Can I just ask quickly on, so I was talking to a hedge fund manager, admittedly at a bar, and he was speculating that perhaps Elon Musk, in order to meet some of these targets, like the market cap target, might roll up SpaceX and Twitter and everything into Tesla. Because
I hope he does.
Yeah?
Yeah, I do. I mean, I don't know how he's going to get there, but he got there last time with much higher odds against it. And I think for me as a shareholder, I read something, Michael Burry said something like, you're getting diluted 3.8% a year. Okay, if I'm up 800% or 500%, I'll take it as a shareholder. So I'd love to go head-to-head on that one.
Historically, it's been a very difficult company to try to go against. Nancy, it's always such a joy to have you on. Thank you so much for joining us. Come back again soon. Nancy Tengler of Laffer Tengler. Still ahead, we're going to speak with the co-head of private capital for EQT, the world's second biggest fund by assets raised. Stay with us for that conversation. You're watching Bloomberg TV.
Let's get out of high interest. Look at what's making headlines around the world. Michael and Susan Dell just dropped a record-shattering $6.25 billion to give 25 million children in America $250 apiece to kickstart their future if futures and investment. The gift expands the new federal Trump accounts, which seed $1,000 for newborns. Dell says this is a way to use his fortune to open doors for a new generation, and they'll give that money to children up to the age of 10. He's one of the richest men in the world, by the way. This is our Rich Go function on the Bloomberg, where you can track these kinds of things and see that he is there with a fortune of $170 billion or thereabouts. Jane Street and Citadel Securities are tightening tightening their grip on Wall Street's trading business. Jane Street's third quarter trading revenue jumped 18%, while Citadel Securities rose 9%, both on pace for record years, helped by volatility from policy-driven market swings. And the Bank of England is reportedly moving ahead with a major stress test of fast-growing private credit companies. The big U.S. firms like Blackstone, Apollo, KKR, and Ares have agreed to take part in this stress test, and it will investigate how non-bank lenders would handle a severe shock amid rising global concerns that private credit risks resemble pre-2008 practices. And on that note, we want to get into our credit segment. Oaktree Capital Management's Danielle Pauly is downplaying concerns about private credit markets. I spoke with her yesterday.
Termites are not eroding the foundation of private credit. I think that's the key. And so while we have seen defaults increasing, we should dissect that a bit because the entire market shouldn't be painted with a broad brush. I'll start with the best. The high yield bond market, defaults are actually low. They're below historical averages, and that makes sense. This is a high quality market, over 50% double B in this market right now. Defaults are increasing, they're elevated in the leveraged loan market.
So I did tell her I don't know as much about the private credit markets as you, and that you were away.
You say this, but you know a lot, Matt.
But I think it's really interesting that these firms are taking part in the stress test. I don't know if they're willing to subject themselves or they've been asked to include themselves, but it'll be cool to see how they do.
Well, you'd think that they'd want to. Okay, it's Blackstone, Apollo, KKR, reportedly Ares is part of it, CVC too. But what a great opportunity for them to say, look, we're not a systematic risk. You can stress test us, but if anything, this highlights that they are as important to the economy, to the lending market, as the banks are. If you have banks and private credit players participating in a stress test.
So not nearly as big, right? I mean, the private credit, non-bank private credit firms are only $2 trillion out of the $13 trillion.
I guess it's the point that they're just growing rapidly, so they're increasing exponentially their importance.
All right, well, it's something we pay attention to on the show. Thanks mostly. But Dani, coming up, private equity giant EQT plans to invest over $250 billion in the U.S. over the next 5 years. We'll speak with the company's co-head of private capital next. Eric Liu joins us on Open Interest.
Private equity giant EQT is embarking on a $250 billion U.S. investment spree over the next 5 years. The company's CEO told this show, Open Interest, last month that the push was part of a return to a robust M&A environment. I'm pleased to say that joining us today is co-head of private capital for EQT, which is the world's second biggest fund by assets raised. That is Eric Liu. Eric, thank you so much for joining us today. And look, there's a lot of excitement about the return to a robust M&A environment, that corporate earnings are really good. But for 2026, we're also talking about a Fed cutting rates, about the economy needing that juice. Can both of those be true at the same time?
I think the M&A environment tends to be robust when acquirers can find targets that make sense and when credit's available. I think credit's available right now. I think the conditions are actually fairly benign. If we have interest rate cuts, I don't know the extent to which it'll accelerate that M&A activity, but I think to some degree it's priced in already to expectations today.
We have hope for a rebound in things like, I mean, we've seen M&A, we've seen IPOs, but it's still not 100% confidence inspiring. Does this continue, you think, through this rough patch that we're in right now into 2026?
Yeah, I think the conditions we're seeing in the absence of any external shocks will continue in 2026. I think you'll see deal activity continue to increase, and other good things continue to happen.
But what about IPOs? Because one of the issues has been exits, right, and returning money.
Yeah, so the IPO market, one of the bankers told me, the IPO market's never closed. It's just more selective about the types of assets that can go public. But I would say the IPO markets right now are open if you have a high-quality company that is either a sufficient scale or has a technological bent that investors like.
In the last hour, we heard from the SEC chief who is speaking at the New York Stock Exchange, basically saying that they're looking at easing rules for smaller companies in order to IPO, because to your point, it has been companies that are some size, have attractiveness. Do you think that there could be some regulatory easing, or is it necessary to have some regulatory easing in order to get more IPOs into this market?
Yeah, I think obviously the burden with being public has been significant and has increased over years. I think that is one sort of limiting factor that's prevented companies from going public. So I think any easing it will help. But I think it also depends on risk appetite in the market more generally. I think that's really been the limiting factor recently.
We were just talking about the Bank of England stress testing, now some private credit companies, and I wonder what you think of the cockroaches conversation, or termites, as Danielle Pauly put it. Is it good, necessary to have these kinds of non-bank lenders in stress tests?
So I think the private credit markets have become a more important part of how we finance our transactions. So obviously there's the syndicated market, which is much larger. But in the past few years, the private credit markets have actually gotten larger and more sophisticated in terms of their ability to finance our transactions. So I think it's been a good thing to have more variety.
But to be clear, you're not doing at EQT, you're a private equity.
So we don't own a private credit business, but we use private credit to finance our transactions.
I would say you somewhat famously sold your private credit business in 2020. You know, I was talking with Per last month. He basically said, never say never, but we're not looking at adding private credit. You are newly, as of the early this year, co-head of private capital. Is there any feeling that you watch this explosion of private credit saying like, dang, I wish we were part of that right now?
So I think when you take decisions, and then obviously the private credit market's huge now, it depends on why you did it. I think for us, you know, the reason we exited private credit was because our entire culture is around growth. How do we add active alpha to our portfolio companies? The problem with credit is you can't make the companies more valuable. And so we actually went the other way. We have the most successful venture capital firm in Europe. We have the growth equity fund. We have a healthcare growth equity fund. We have all sorts of equity products. So we're one of the largest private equity firms in the world that does not have a credit business.
You're one of the success stories in PE, and there are others, but people talk about zombie firms in private equity as well. What separates the winners from the walking dead in this market?
Yeah, so I think in terms of private equity, what's happened is as the asset class has matured and as it's grown, our clients have also evolved. And what you find is that the clients really want it like one-stop shops. They want one firm they can go to for private equity exposure, infrastructure exposure, real estate exposure. And so that's created an environment where the large firms have gotten larger, they've gotten more diversified. And also the regulations on our industry have also increased. And so you need a certain amount of scale to actually deal with these regulations so that most of the people at your firm can focus on finding good investments and making them more valuable.
By the way, with all these zombie firms, have you found that there's less competition, especially for like middle market firms? Has it almost gotten easier? As Matt puts it, there's more walking dead among us?
Yeah, the short answer to that is no. Our industry remains quite competitive.
All right, fair enough.
I wonder about a story in the FT that says you're now going to raise charges on institutional co-investors and getting away from the free co-invest model. What's spurring that?
Yes, I think they were referring to our Q3 earnings call where our CEO mentioned something. But the reality is our institutional investors are the most important part of our business. We generate a significant amount of co-invest relative to the amount that they put in their funds. We're frankly industry leading on that metric, and we'll continue to be that way in the future as well.
Dude, great having you in the studio. Thank you so much for joining us. Hope we get you back again soon. Eric Liu there of EQT. This is Bloomberg.
After a Black Friday with sales topping records, Meredith Whitney says that there are cracks in the consumer, but they are hiding in plain sight. In one of her latest notes, she writes that while we have not believed that resumption of student debt payments would tip the U.S. economy into recession, it is clear that it has had an impact on spending, particularly to what we refer to as avocado toasters. Here to explain is Meredith Whitney Advisory Group CEO. And I think that's perfect because, as you also note, it's these fast casual, the Cava, the Chipotle, the Sweet Green that haven't done well. Matt and I were talking about that there's this great Bloomberg story that it's like the slop bowls are no longer popular. How do you sort of decide what is just changing tastes and what is real weakness among some consumers, especially millennials?
So the taste thing is way beyond my purview, but I can tell you what's going on with the economy and with the data. So one thing that is clear, the student loans forbearance, it was basically a 5-year period where people didn't have to pay back their student loans with no penalty. And I'll get into the numbers in a second, but that resumed at the end of 24. So we're well beyond 9 months of it impacting the fact that students, a big portion of the millennials, the avocado toasters, 52% of them own student debt. So over 1 in 4. So the avocado toasters own 52% of all the student debt. $850 billion. So the fact that they have less money, less discretionary spending every month has impacted. And this is something we've been focused on since September, but only in the third quarter numbers did the companies start to talk about it. But let me give you an example. So no one would argue that the COVID stimulus checks that went out to 165 million Americans was stimulative. That was $814 billion. But 400 billion went out to fewer than 40 million Americans in terms of not having to pay your student debt. That equated to 400 billion. So that's not only $300 a month, it's $17,000 per consumer over the course of nearly 5 years. Undeniably, you have a lot more discretionary spending, so you're going to spend on travel, anything discretionary. You don't think about spending $8 on a French press coffee, or $17 on a burrito bowl, or
and you develop habits, right? And you
develop
you get a higher mobile phone bill, and maybe your car payment grows, and that's okay because you're not paying your student loans. Then all of a sudden, October of last year, you got to pay again, but you've got all these costs built into your budget now.
Yeah.
And that's why they can't turn it around.
That's why they can't turn it around. And something else that happens is 35% of all students, 28% of all student debt is owned by this avocado toast generation. They don't have assets. So on average, they have 15% of the assets that someone over 55 will have. So they have all of this debt, no equity, no way out. And 35% is the number that owns, that's in terms of all the auto debt they own too, to your point of car payments. So as the gearhead that you are, auto loans have been pretty clean, right? There haven't been a lot of delinquencies or defaults.
Prime auto loans.
I think that's Tricolor was probably the exception.
That was
right?
subprime.
Right, subprime. But I think that's going to now bleed into the auto loans, because students are going to get crowded out by not only having to make these payments, but if you haven't made a payment and you're either in default or you're serious delinquent, 20% of student debts are either in default or serious delinquent. The government's going to start wage garnishments. That started this summer. And so even if you look at the One Beautiful Bill, which is tax refunds, the Treasury has this TOP program. They'll garnish your tax refunds, and so I don't see there's a way out for this.
I can't have my wages garnished.
Well, I was going to say, because there has been this narrative that's evolving, that you're going to get tax refunds, maybe a $2,000 check in the mail because of a tariff rebate, and that's going to cause inflation.
Scott Bessent says they're going to save that.
I was going to say, but maybe is Scott Bessent right if all of a sudden you do have resumption of student debt, that money is actually going to be used for being saved, for paying down debt, and maybe not fed directly right back into the economy?
Okay, so I think what Treasury Bessent also said is that it's got to pass Congress, which I don't think it's going to pass. So I think that was his way out, that's probably not going to happen. But if there's, what's the estimate on the One Beautiful Bill tax give back? It's like $265 billion. Well, in terms of we estimate what is in default or serious delinquent is $170 billion of student debt. So that gobbles that up. So there's not a great way out for this demographic. And I think what's really interesting is businesses have catered their entire marketing strategy to this holy grail of millennial Gen Zs, which they think is going to be this bastion of endless discretionary spend. They've got to really rethink those strategies.
By the way, I wonder first of all, it's shocking to me that millennials hold 35% of all auto loan debt. And it's an interesting fact.
Avocado toasters.
Avocado toasters,
right.
And I'll be using that on my podcast, Hot Pursuit, which is just about cars. What about the younger generations? Are they not taking student debt as a result of this, or do they not have the problem because they didn't go through this period where they didn't have to pay? And
well, I think psychologically, when you don't have to pay a loan for nearly 5 years, there's not only an issue of ability but willingness, because it's just out of your mind. So the trend in younger people is they're not going to college because it's really expensive and they haven't seen the return on investment. So so I just think
so they're not getting saddled with this kind of debt, but the problem is really the fact that these debts aren't being paid, and these kids are going to have, or kids, not kids anymore, right? Here's an avocado toaster right here.
That's me.
Yep.
They are going to have to start paying the debt, or they'll have their wages
and tax refunds garnished.
But
either way, it's going to impact their whole outlook on how they've looked at the world in terms of, there's another issue of, like, if you have an Amazon culture, you tap and you don't realize that you're spending all that you're spending, as opposed to our generation, which is, I ran out of cash. That's it.
This generation, though, it's becoming a growing political force, and the concerns about affordability. I think the mayoral election here in New York was a really big sign of that, and it's something that the Trump administration has been paying attention to. All of a sudden, all these affordability pushes are starting to enter. So as we get closer to the midterms, how much do you expect policy to affect this? Are you expecting any big policy changes that could eat into your concerns at all, or is this just too big of a problem for policy to tackle?
You've nailed it. So this is what I think is the most important factor in 2026, which is it's all going to be about affordability all the time, because this will be what gets people either elected or elected out of office. And the one thing the administration can do, because they can't do much on pricing, the one thing that they can do is fast track this this bill that came out of the Senate Banking Committee. It's called ROAD. It's trying to make housing more affordable, and that's now in the House Banking Committee, and they're working diligently to mark it up. But effectively, it's going to, most real estate problems are local, but let's say 25% of them can be federally looked at. They can change, this is probably up your alley, a 1974 chassis law that will reduce the cost of manufactured housing, which is the only way to get real affordable housing into the sphere of more American, like the American dream. That would reduce manufactured housing by almost a quarter and create like a 5x production cycle on manufactured housing. So I think manufactured housing is the way to look at this. But housing is going to be something that the administration can do, and that's also doing affordability, opportunity zones, redistricting how lot size, so you can make lot size more affordable. But everything is going to be about affordability. What can you do? You can do something on housing.
I wonder if, investors who are watching this and they're like, wow, I hadn't thought about, they're running your numbers. Can they be a little bit more sanguine if they think the Fed is going to cut to 3% or an even lower terminal rate? Or does that, do those kind of rate cuts have no effect on avocado toasters with these kind of issues?
I don't see the rate cuts being meaningful at all to affordability. And here's why. Because housing is about the cost of housing, not just rates. So the overall cost, if home prices stay this high and rates are low, it doesn't really affect the affordability factor. And then for subprime lending is really not a factor. So if you reduce rates on subprime, there's just not a lot of subprime credit out there now. Maybe it affects the higher end a little bit, but I don't see this being a rate issue. You lower rates, potentially you could increase prices even higher. So it is not a rate issue. It's a structural issue that you can have. They're fixes, and they're creative fixes. Housing's the first one.
All right. This is something we'll be thinking about and talking about for a long time to come. Meredith, great having you here on set with us. Thank you so much for joining us. Meredith Whitney there now, the Meredith Whitney Advisory Group. Coming up, the Christmas Trade Group has a tariff exemption on their holiday wish list. We speak to the leader of that group and the CEO of the National Tree Company, Chris Butler, joins us next. This is Open Interest. Artificial trees may be everywhere this holiday season, but the business behind them is facing its toughest year yet. From tariffs to shifting consumer demand, National Tree Company CEO Chris Butler says this season is unlike any other. He joins us now on his expectations for the holiday season. And Chris, let's clear up first. I heard a stat that like 83% of people choose an artificial Christmas tree over, a cut down Christmas tree. Is that true?
100% true. Yes. Wow. Consumer over time has just decided to, take convenience and kind of take cost effectiveness over natural trees. Again, we at National Tree, we support consumers using all trees, whether it be natural, artificial, but, the consumer has voted and, we continue to see a kind of heavy uptick in the artificial market.
Is that share growing, Chris? Because there has been this conversation. It feels like, every day I read some article that's like, oh, your spatula has forever plastics in it and it's killing you. And there does seem to be this real kind of turning away from some of the concerns about the plastification. That's definitely not a word, but concerns about this in this economy. How has that kind of changed your business and how people view this as a sustainable option versus just having more plastics in the home?
Yeah, I think, look, when I first got this job, a couple of people came to me and said, we need to attack the natural tree business because, it's unsustainable, et cetera, et cetera. I'm like, well, the business in general is not the world's most sustainable business, right? Because our trees are made from PVC, from polyethylene. And so, again, our trees last, 10 plus years if you treat them well, you store them well and things. And so, we think that, again, our trees are a good way of, again, helping the environment from a standpoint of not cutting down trees, but also it's not kind of our main message. We are looking at different materials, recycled PVC, recycled plastic bottles. So we have multiple items now where we're looking into recycled materials. And so that is something that we continue to do to push forward and to ensure that we give all consumers what they're looking for.
You are seeking an exemption or an exclusion on tariffs. As the leader of the Christmas trade group, we teased it. You've got 10 members, over 1,000 employees in your organization, bringing in $1 billion of revenue each year. How's that going?
We've had great conversations. We've had great conversations with Senate Finance Committee members. We've had great conversations with U.S. Trade. We've had great conversations with some of the faith-based officers at the White House. So, look, I think that the bigger picture is, when the tariffs went into play, again, tariffs can be a good tool to, from a defense perspective, from IP perspective, but I don't think anyone in the administration or anyone in government was planning on increasing the cost of Christmas, right? I mean, that's just something that wasn't on people's radar. So, we've got caught up in that. I think as you've seen over the last few weeks, months, there have been items where tariffs are being rolled back. So whether it be coffee, bananas, mangoes, typically if it's not grown in the US, I think we're starting to see rollbacks on these tariffs. And so what we had the conversation with US Trade a few weeks ago is, look, we can't get the raw materials necessary to make our trees in this country. And so, until that happens, until that's readily available, we believe we should be treated the same way as coffee, bananas, et cetera, et cetera. So that's really kind of the angle we're coming from. Again, we've had great open conversations, and we hope those conversations and dialogue will continue.
You say the administration didn't want to increase the cost of tariffs, but Trump early on did say maybe you just buy one doll for Christmas instead of two. Chris, how have tariffs affected you? How much has it increased costs? How much have you had to rethink your supply chain?
Yeah, so a couple of things. So, at the beginning of this year, it was all about supply. It was all about supply. Where do we get our product from? How much is that product going to cost? And can we bring it in time? And, the back half of the year is all about demand. I'll get into that in a minute. But, the tariffs had a massive impact. 93% or 95% of this industry is made in China. And so when the Chinese tariffs came into play at 56%, obviously that was a huge shock. When they went into 145%, all factories just stopped. There was no more factory production for about 30 days. As a company, National Tree had moved our production, or at least a good portion of it, into other countries just to diversify our production. We like to be diverse. We like to have a flexible supply chain. We think we have one of the best diverse supply chains in the world. But many of the other members in the Christmas trade group were stuck in China. And so a lot of people started to try and get out of China very quickly, which then slowed down supply chain overall because a lot of the raw materials still are sourced out of China. So long way of saying, there was a lot of chaos at the beginning from a supply chain perspective. After Liberation Day, tariffs kind of rolled back a little bit, and we got to more sustainable levels of 10% at some countries, 30% in China. Production ramped up back up again, and production started up and started to ship products across. But there was definitely a gap. So we believed there was going to be a supply shortage. Not to mention, obviously, the cost increases. So, we as a company at the Christmas Trade Group, prices are going up anywhere between 10 and 15%. And again, that is to kind of cover some of these cost increases. We've had some of our manufacturing partners try and eat some of that. We've tried to eat some of that, and then obviously we've passed a little bit on to the consumer. So that's what's happened. And look, right now, I can tell you many, many members of the Christmas trade group, many, many people who make things in China, as I'm sure you guys are well aware, are looking to get out of China, looking to diversify into other countries. We're still on that road. We believe we could be 100%, or we will believe we will be 100% out of China in 26 if we choose to be.
Chris,
again,
I want to ask about the demand side for your business, and you do not just Christmas trees, but Halloween and Easter and Valentine's Day. And I don't know if it's because now I'm having to do it myself, but I've noticed a hell of a lot more homes decorated for Halloween. And these things are not cheap, right? Buying a giant zombie or whatever for your front yard is a significant outlay. Has demand just in general exploded for these kinds of seasonal home decorations?
Yeah, I think you've got a couple of things. It's a great question. So Halloween in particular is something now that definitely more and more people are putting money into and decorating their home. So you're just seeing a general increase in the number of families that are decorating their home. From a Christmas perspective, people, it's the show me generation, whether it be on Instagram, Facebook, TikTok, etc. People now love showing off their home decor and love showing off their homes. And so decorating more is a big part of that. Having family and friends over post-COVID is a big part of that. But, I can tell you this year, Christmas trees, wreaths, garlands are discretionary items. And, we've definitely seen quite a lot of softness. We've seen some of our major accounts see significant softness across the board here. So, the consumer's just not spending on discretionary right now. They're spending it on eggs, they're spending it on other household essentials. I think they're spending money on themselves, whether it be for gifts or for gifts for themselves. But right now we're not seeing them spending on discretionary items such as decor. So this year for sure was a soft year. We're hoping to get back to normalcy next year.
It did not look that way, Chris. Just based on all of the giant skeletons that terrified my nephew. For his sake, maybe we should pull back. Chris, thank you so much for joining us. Chris Butler of the National Tree Company. Coming up, $250 for 250 million American kids. More on Michael and Susan Dell's $6 billion+ donation. This is Bloomberg Open Interest. Michael and Susan Dell are donating $6.25 billion to fund the Trump Accounts program for children. The president praised the move, writing on Truth Social, quote, "Two great people. I love Dell." Bloomberg senior editor Mike Shepard joins us now in Washington. Shep, this is just an insane amount of money to be donating.
It is an insane amount of money to donate, and the idea is to give an additional group of children access to this program, known informally as the Trump Accounts, but formally as the Invest America Initiative. And it actually predates Donald Trump's time in office. It's the brainchild of Silicon Valley venture capitalist Brad Gerstner, who really wanted to come up with a way of closing the wealth gap in the country and increasing financial literacy. And basically, the government for children born between 2025 and 2028 will seed $1,000 for investment accounts that parents can open on their children's behalf and then continue making contributions until they reach the age of 18. And this is something naturally that the president embraced, and he even featured it at an event in June that Michael Dell attended together with Brad Gerstner, where they hailed this program.
And I guess that's only for the Trump accounts. The $1,000 is only for kids, as you say, born 25, 26, 27, 28. This donation is going to be to kids under the age of 10 or maybe up to 10, right? So even existing children will get hold of this $250. What do you have to do to get into this program?
I mean, you'll really have to go through the Invest America platform to try to access this. But the idea is really basically the same. And this is what Michael Dell is hoping to do, is to reach beyond the smaller cohort of children born between those years and try to expand possibly the availability of access to these accounts. And it's important to note that the idea is to put this money into low-cost index funds that have some measure of security, and that children would be able to eventually, when they reach adulthood, would be able to use that money for education, to buy their first home, or even cover some startup expenses.
All right, Mike, great having you on the program. What a feel-good story. And also Dell stock, you can see moving up 4% in today's trade. Bloomberg's Mike Shepard there in Washington, D.C. Coming up tomorrow, Keith Lerner of Truist joins us. Sarah Hunt of Alpine Saxon Woods as well. The two of them will play tennis with me and Dani. This is Bloomberg Open Interest.